We have been doing books of prime entry, or call them books of original entry, for quite some time now. And in this session, we are going to do the very final one, which we are calling the general journal. But before I get into the general journal, I would like to give you an overview of all these books of prime entry that we have been doing in our previous sessions. We have done the sales journal. The sales journal is our book of prime entry, or book of original entry, where we record credit sales. Now, when I talk about books of prime entry or books of original entry, I am talking about the accounting book where records are first put, or records are first recorded, if I may use that phrase, when we are getting this information from the source documents. So each and every book here has got specific source documents that we rely on to record into them. I discussed most of these details in our previous sessions. So let's go over them very briefly. Sales journal. In the sales journal is where we record sales or credit sales. In the purchases journal, it's where we first record credit purchases before we launch into the double entry. Then we have the returns inwards, or the sales returns journal. This is where we record returns inwards, or call them sales returns. Then we have what we call the returns outwards journal. It's where we record the returns outwards. Then we have the cash book. In the cash book is where we record all cash receipts and cash payments. Then we also have the petty cash book. In the petty cash book is where we record petty cash expenses. Then from there, we now get to the gist of the matter, the general journal, or sometimes it's called the journal proper. Now, like I have been mentioning the books of prime entry above, I have been mentioning the book, and I have been mentioning the category of transactions that are recorded in that specific book of prime entry. Now, for all the categories of transactions that have not defined in the books above, those category of transactions are recorded in the general journal. In this session, I am going to show you some uses of the general journal, or some of the category of transactions that are recorded in the general journal. However, I am only sampling just a few very common uses of the general journal. So the list that I am going to give you is not a comprehensive one, but the general idea you should get is that if the transaction that you're looking at is not described in, or it does not fit in the books that you're seeing above, then that transaction, its book of original entry, is the general journal. Or in other words, it is where we first record it in the general journal before we do the double entry postings in the relevant ledgers, depending on the transaction. So let's go ahead and look at some of these main uses of the general journal. We can use the general journal to record purchase and sale of fixed assets on credit. Now, this should not be confused with purchase or sales of goods on credit. Remember, we said goods are things you buy with the intention of selling them. So if there is a purchase or sale of goods on credit, those are first recorded in either the purchases journal or purchases day book, or the sales journal, or call it the sales day book. However, when we are talking about fixed assets are not things that you intend to resell. For example, if you buy furniture in your shop, this is furniture you're going to use in your shop. You do not intend to resell it. However, in the event that you're going to sell it, this is not to be recorded in either the purchases journal or the sales journal. This is recorded in the general journal. So I hope you've got the distinction. In some of the uses of the main journal is to record purchase or sale of fixed assets on credit. Of course, it is supposed to be on credit. If it is not on credit and it is on cash, that is when we record them in the cash book. But because it's on credit, it's either because it's on credit, that kind of transaction is handled in the general journal, or call it the journal proper. So we also have writing off bad debts. Definitely, we are going to look at that illustration later on in the video. Then we can correction of errors in the ledger accounts. As we are moving on in this series, this is a whole topic in accounting: correction and identification of errors. we will be able to look at it in depth. But however, our book of prime entry when we are correcting errors is the general journal. Then also we have opening entries. I'll be explaining this a bit more later on in the video using a worked example, and definitely also adjustments to any of the entries in the ledger. In case you need to adjust any entry in the ledger, the first entries are made in the general journal. So let's get straight into the gist of the matter. Let's look at how a general journal looks like. But first, we look at the general journal we can use it for purchase and sale of fixed asset on credit. Let's look at that. Before we go into a worked example on that, that is how a general journal looks like. We have the date column, definitely the one we use to record the date when the transaction takes place, the details or particulars. Now, in the details or particulars column is where we record the accounts that are affected by a specific transaction. Then we have the folio column where that references where these accounts are located, then the debit side and the credit side. Let's get straight into that. We have a motor vehicle which is bought on credit from Spear Motors Limited for 10 million, and this took place on 1st December 2020. So now, this being a motor vehicle, it is a fixed asset. It is being bought from Spear Motors Limited for 10 million. So this is a fixed asset. Now, here it's the assumption that the entity buying this vehicle does not actually deal in vehicles, because if we are dealing with an entity that deals in buying and selling of vehicles, then it means this is not purchase of a fixed asset, but rather it's like a purchase of a good. The motor vehicle is a good, but here it's not the case. I hope you get the difference. Here it is an entity that is dealing in something else as its main business operating activity. However, it decided to buy a motor vehicle on credit from Spear Motors Limited. So what are the items that are affected by this transaction? Of course, we shall first write the date. The thing happened on 2020, December that is on 1st. So the items affected are the ones that we're going to put in the details or particulars column. So in this case, when you bought a good from this motor vehicle on credit, the motor vehicle account is opened, and that one is going to be debited because we have a new asset into the business called motor vehicle. So we are increases in assets are debited, so we are going to debit the motor vehicle account. The other item that is affected is the Spear Motors Limited. This so happens to be a creditor now to the business because they've given us a vehicle on credit, so they are a creditor to the business, and we shall go ahead and increase their account, that is by crediting it. So what happens is, after writing those two, we put the narration down here to explain what is going on, and the explanation, or call it the narration, is that these two entries are being purchase of motor vehicle on credit, and probably you put the source document reference capital purchase invoice number 011. Then from there you go to the respective ledgers where you're going to find these accounts. The motor vehicle account is found in the general ledger, and then the Spear Motors Limited account is also found in the purchases ledger, because it is in the purchases ledger where you're going to find all accounts of our suppliers and people who give us stuff on credit. So the general ledger, we shall do just exactly that. We debit the motor vehicle account. The other item affected is Spear Motors. It took place on 1st December. Then we shall complete the double entry by crediting the Spear Motors account at 10 million. The other item affected is motor vehicle account, and it took place on that date. So after that, that's it. So we come back to our general journal, and then we reference the accounts. The motor vehicle account is found in the general ledger on page 1, and the Spear Motors Limited account is found in the purchases ledger on page 1. That's what we are that's why we are putting those PL1 and GL1. Moving on to the next. Sale of furniture no longer required in the business for 3 million on credit to Katagwa on 5th December 2020. So we are selling furniture we no longer need in the business. So this is sale of a fixed asset. So when we sell that furniture that we no longer need at 3 million on credit to Katagwa, it means Katagwa is going to become our debtor. So we shall start with writing the debt. when it happened. Then after writing the date, we shall identify the accounts that are affected. What are we going to debit? Of course, when we've sold this to Katagua on credit, it means Katagua becomes a debtor to the business. A debtor to the business, that's an asset to the business. Increases in assets are debited. So it means that we are going to debit debtor Katagua account by 3 million. And then the other item affected is definitely the furniture account. The furniture that we are selling has reduced. Reductions in assets are credited. So we shall go ahead and credit the furniture account with 3 million. And what's the narration? The narration being sale of furniture no longer required in the business on credit. See reference letter, whatever, as in you put some bit of, evidence to support whatever is going on, or sometimes you can leave it out. So from there, you go ahead to the respective ledgers. You go to the Katagua account, it's in the sales ledger, and you debit his account like we have done in the general journal, or call it the journal proper. And then we also go to the general ledger, find the furniture account, and you credit it just like we have been doing in the general journal and like you're seeing on the screen. After doing that, we are supposed to go back to our general journal and fill the folio column. The Katagua account is in the sales ledger on page 1. That's why we are saying it is SL1. And then the furniture account is in the general journal on page 2. That's why we are putting there GL2. So that's it for sale or purchase of fixed assets. Let's go to something else. Writing off bad debts. Now, of course, sometimes when we issue things on credit, sometimes our customers may not pay, and when they do not pay, that is considered a bad debt. A bad debt is an expense to the business. Let's look at this example. A debt of 78,000 owing to us from Mandela is written off as a bad debt on 8th December. So Mandela owed us money, but he was not able to pay. So that is a bad debt. Now, what happened before this bad debt was eventually written off? Mandela owing us money means Mandela was a debtor to the business. And so it means that his account had a debit balance. Because increases, all asset accounts have debit balances. However, if he's failing to pay his account, it means we are supposed to write off his account. And so writing off his account means that we are supposed to do the reverse entry. We are supposed to go ahead and credit his account by that amount of money that he's failing to pay. And then we shall open up a new account we are calling the bad debts account. And remember, a bad debt is an expense to the business, and so we shall go ahead and debit the bad debts account. All expense accounts are debited. So we shall go ahead and write the debt, and then we shall say, because this is a bad debt, we debit the bad debt account being an expense by 78,000, and then the Mandela account will be credited like I've been explaining. The explanation of the narration being debt written off as bad, or bad debt written off. Whatever English you use depends on the primary school you went to in learning your English. So from there we shall go ahead and go to the respective ledger accounts. In the general ledger, we go to the bad debts account in the general ledger. Bad debts being an expense, we shall go ahead and debit it by 78,000. The other item affected is Mandela. It took place on that date. Then we shall say do the same. Do the corresponding credit entry in the sales ledger by posting 78,000. The other item affected is bad debts. This took place on December 5th. We know bad debts, as you can see on your screen, is on page 3 of the general ledger. The Mandela account is on page 2 of the sales ledger. So we shall come back to the general journal and we shall do the referencing, or we shall post in the folio column by putting GL3, meaning that the bad debts account is found in the general ledger of page 3 and the Mandela is found on the sales ledger on page 2. Moving on to the next. We can also use this for opening entries. We post in the general journal to do opening entries. Now, what do I mean by opening entries? Now, definitely, like the word says, opening entries are simply entries that are opening the books of accounts. Now, it is the common practice that actually most businesses do not operate using proper books of accounts. Most businesses operate without proper books of accounts. But also, it doesn't mean that it's going to continue like that forever. Sometimes, midway the accounting period, or along the way, or along the course of business organization, somebody or the proprietor of the business might decide to start doing proper books of accounts. So when they decide that they need to start doing proper books of accounts, they'll go ahead and invite an accountant, and this accountant needs to make the opening entries to all the accounts. So these opening entries, when they are being made to open up the books of accounts for an entity that has already been existing, these opening entries are first posted in the general journal, or call it the journal proper. Let's look at an example to illustrate this. We have this. On 1st July 2020, Nyamaizi decided to keep proper accounting records after operating her business for some years. So this is what she established. She established that those are the amount of assets she has in her business, and those are the amount of liabilities that she has in her business. So we are being required to open her books. So yes, we have the assets right there, we have the liabilities right there. So after establishing what she has, the total assets are 43,070,000 and the total liabilities in her business are 420,000. So after establishing that she has these amounts of assets and those are the amounts of liabilities, we need to find out how much capital she has. So we shall rely on the accounting equation. So in our previous session, we said that the accounting equation states that assets are equal to liabilities plus owner's equity, or call it capital. I'm using the word owner's equity and capital interchangeably. We've already seen that the total assets are 43,070,000, the total liabilities are 420,000. Then plus capital, we do not know capital. So we go ahead and find capital by making capital the subject of the formula. It means capital is equal to 43,070,000 minus 420,000. And we shall end up with a value of capital as 42,650,000. So after finding our value of capital as that, then we go ahead and, start making our analysis. But before we know it, we need to know one thing. Remember, according to our double entry rules, that all asset accounts are debited. So we shall make a debit entry. All asset accounts have a debit balance. All liability accounts have a credit entry or a credit balance, and all capital accounts have a credit balance, so we shall make a credit entry. So in this case, as we are making the opening entries, all assets accounts shall be debit entries, liability accounts shall be credit entries, and then capital account shall be credit entry. So from that, we'll go ahead and make an overview here now. From here, you can see that from our assets, the total is right there, 43,070,000. The total liabilities is 43,070,000. We've been able to balance those two sides. After finding the value of capital, we got the value of capital by applying the accounting equation. So from there, we will go right ahead to our general journal and post the opening entries. So here we are. On that first date, we have the van. We said the van is an asset, so it shall be a debit entry. So it's 37 million. We have fixtures, that is also 1,800,000, a debit entry. Stock is a debit entry. Debtors is an asset, so that's a debit entry. However, we have data Muhumuza. Then we also have another data called Kalyango. Muhumuza is 60,000 and Kalyango is 10,000. Then we shall go ahead and start with the creditors, which so happen to be, liability accounts, and these ones are credit entries. So the creditors we have here, we have creditor Kellen, and that is 400,000. Then we have creditor Sudil, which is 20,000. Then definitely, finally, we have the capital account, which so happens to be 42,650,000 on the credit entry, or the credit side of the general journal. After doing all those entries, we shall go ahead and add them up. The total credit side is 43,070,000. The total debit side is the same. Assets and liabilities are the same. So we go ahead and do the narration and say that these totals are as a result of being assets and liabilities as at this date entered to open the book. So in other words, we have posted the journal entries that we needed to make to open the books. After posting the journal entries that we need to open the books, we are going to go to these respective individual accounts, open them up, and post the debits and the credits like they appear in the general journal. So that is exactly what we are going to do. So we shall go ahead to the van account. It's a debit. We go ahead and post it like that. The details column, of course, shows that this is the balance. The fixtures, same. 1.8 million is the balance. Then we have stock. It's a debit entry right there. Then we have data Muhumuza. It's a debit entry right there. Then we have data Kalyango. It's a debit entry right there. These are asset accounts. Then we have creditor Kellen account. This is a liability account. It's a credit entry right there. Creditor Sudil is a credit entry right there. Then we have the capital account, which is also a credit entry right there. So after doing that, we come back to our general journal and we fill the folio column. We're supposed to indicate where these respective accounts are found. So in the van, we shall say GL1 means the van account is found in the general ledger on page 1. The fixtures are found in the general ledger on page 2. The stock account is in the general ledger, page 3. The data accounts are found in the sales ledger, page 1. The Kalyango account is in the sales ledger, page 2. The creditors account are found in the purchases ledger, page 1. The Sudil's account is found in the purchases ledger, page 2. And the capital account is found on the general ledger on page 4. Basically, that is how we make opening entries. Now let's move on to another use, adjustments to any entries in the ledger. Now there might be some adjustments that you might need to make. It depends. So we make these adjustments into the ledger by first posting these adjustments to the general journal. We have a transaction here. Kabalia is a creditor, and from what you can see, on 10th July 2020, his business is taken over by Lincoln, to whom the debt of 100,000 is now to be paid. In other words, we are running a business, and at first we were dealing with Kabalia. Now Kabalia runs into maybe some problems, and his business is taken over by Lincoln. Now, much as the business has been taken over by Lincoln, according to us, we still need to pay this business the amount of money we owe it. So yes, earlier it was Kabalia. Kabalia was a creditor to our business, and in our books, that is how he was written, as Kabalia, the creditor to our business. But now, if the business has been taken over by Lincoln, it means we need to make the necessary adjustments in our books of accounts to show that now we owe the money to Lincoln. Or in other words, Lincoln has now become our new creditor and it's no longer Kabalia. Those kinds of adjustments are the ones I'm talking about. So here is how the account looked like. When Kabalia was still our creditor, we owed him 100,000, so that is why the Kabalia account has a credit balance of 100,000 right there. However, when Lincoln comes into the picture, or when Lincoln takes over the business where Kabalia was previously a creditor to us, it means we create a new account for Lincoln, like right there. So it means that this 100,000 that is on the Kabalia account needs to be transferred to the Lincoln account. But the process of doing that is, first of all, we need to close off Kabalia's account. Closing off Kabalia's account means we are going to debit the Kabalia account so that it is closed off. After debiting Kabalia account to close it off, then we shall go ahead and make the corresponding credit entry on the Lincoln account. This is what we are going to do, but we just don't do it direct. We first post these entries into the general journal. So we'll go to the general journal on that date, and then the The debit, we are going to go ahead and debit Kabalia account. We are debiting it by that amount of money because we are closing it off. So that entry closes it off. After closing it off, then we shall go ahead and credit the Lincoln account by the same amount of money that we owe them, because now Lincoln now becomes our new creditor by 100,000. And the direction being, this is being transfer of indebtedness from Kabalia to Lincoln as per that letter or whatever evidence you might present there. Then after doing so, we shall come and do exactly that in the Lincoln account. We'll go ahead and debit and credit the Lincoln account by 100,000.